Hello everyone, warm welcome to Testbook Super Coaching. My name is Madhav. I welcome you all in a very important session where we are going to discuss MCQs based on finance. If you are preparing for RBI Grade B 2024 Phase 2 examination and you are going to write this examination on 19th of October, then this is a must session for everyone. So before we start the discussion, please reply in the comment section that I'm audible, visible, everything is fine. We are good to go so that we can begin the discussion. I have many important questions for you all in this particular session. I'm pretty sure you're going to enjoy the discussion as it's going to help you a lot in your upcoming 19th October examination. So let's begin the discussion with the first question of the evening on the screen. The question says, which of the following statement is or are correct with respect to the country risk? The term over here is country risk. I give you a hint, credit risk. Then in credit risk, we talked about counterparty risk. If you remember, counterparty risk. If you remember, after that counterparty risk, we have talked about the group risk and then country risk. So let's talk about this. It refers to the uncertainty inherent with investing within a given country. Okay. It can be seen in emerging markets or countries that have a severe deficit. Okay. It affects stocks, bonds, and mutual funds within a particular country. It affects bonds. Along with that, it's stocks, mutual funds within a particular country. Please check out all the options and give me the answer in the comment section for the given question. Question is pretty easy, but I would say it's confusing. It's not difficult, but yes, it can be said as confusing because first of all, you must know what is country risk. So country risk is basically associated with the uncertainty when you invest in a particular country. So country risk basically talks about the uncertainty at the time of investment in a particular country, and more especially the degree to which uncertainty could lead to losses for the investors. So now it denotes the risk that a foreign government will default, and if the foreign government will default, automatically there will be a risk related to the bonds, there will be a risk related to the financial commitments which you have done with the nation. So in that particular aspect, if we say it refers to the uncertainty inherent with investing within a given country, no sir, it's not within a given country. It is when we are investing in some other country. It's not within a given country. Next is it affects stocks, bonds, and mutual funds within a particular country. So it will affect the bonds, mutual funds, not within a particular country. It is basically related. It is basically related to the nation in which you are going to invest. Basically related in the nation you are going to invest. Now, the moment I say out of all the three statements, which statement will be correct, then what will be the answer? See, if I am an investor and I am investing in a particular nation, whether I'm investing outside the country I'm residing or I'm investing within the country I am residing, then in both the cases, if there is uncertainty inherent with investing in a country, that is a country risk, that is correct. So this within a given country or within a subjected country or within the country you're talking about, both the statements will be correct. It can be seen in emerging markets or countries that have a severe deficit, that is true. The countries where we have the emerging markets or the nations which have severe deficit, in those countries we can witness country risk, that is true. It affects stocks, bonds, and mutual funds within a particular country, obviously. So the answer to this particular question is, so all the three statements which are given are correct with respect to the country risk. That is absolutely correct. Moving on to the next question. The next question is again related to an important aspect. Consider the following statements. It is used by those investors investing in market linked instruments. Okay. Forward contract, future contract, and money market are used. Money markets are the used as hedging strategies. Okay, hedging increases liquidity as it facilitates investors to invest in various asset classes. So all these three statements are given with respect to hedging. We have to identify that which all statements are correct. What is hedging? Simple as it. In case of hedging, let's take an example. So there is an individual A. This individual is having shares of a company, let's say Tata. The current price of this share is 2000 rupees per share. Okay. Now this individual wants to sell the shares, but not today, after 2 months. And after 2 months, the price of the shares may increase or decrease. So in order to mitigate the risk, A will tie up or sign an agreement with the party that after 2 months, I will be selling you the shares of Tata at 2000 rupees, irrespective of the market price. Market price could be more than 2000, it could be less than 2000. So when I sign this kind of agreement, in order to avoid risk due to change in the prices over the period of time, that is known as hedging. So it is used by those investors which are investing in market linked instruments. Yes sir, because market linked instruments means the instruments which witness the price change over the period of time. Forward contracts, future contracts, money markets are used as a hedging strategy. Yes, forward contract, future contract, they all are used as a hedging strategy where you tie up or you sign an agreement in order to avoid the risk due to the change in asset price. Hedging increases the liquidity as it facilitates investors to invest in various asset class. That is also true. How it is true? Because if you are hedging, your risk decreases, because of which you can invest in different asset classes in order to assure profits in the near future. So according to that, all the three statements are correct. So my answer will be 1, 2 and 3 is the correct answer. Moving on to the next question. The next question says, which of the following statement is or are correct with respect to foreign exchange risk? With respect to foreign exchange risk. What is foreign exchange risk? So foreign exchange risk basically means the risk which you are going to witness at the time of trade, or when you are involved in a trading of foreign exchange, Now in this particular case, first point, it refers to the losses that an international financial transaction may incur due to currency fluctuation. Absolutely correct. Market risk is a type of foreign exchange risk. Market risk is a type of foreign exchange risk. This is important. Market risk is a type of foreign exchange risk. This statement is important. Then the next is, it is a major risk to consider for exporters, importers and businesses that trade in international market. That is also true. So according to this, market risk is a type of foreign exchange risk? No sir. Market risk is not a type of foreign exchange risk. So foreign exchange risk, it refers to the risk which is involved when you are trading in the foreign currency, or when you are involved in the foreign currency. And when you get involved in the foreign currency, when you are involved in various aspects, that could be import, export and all. So according to that, 1 and 3 are correct. Second is not correct for this particular point, and market risk is not a type of foreign exchange risk, and according to that, C option is the correct answer. Got it? Moving to the next. Next question is again really very important. Let's see who all can give me the answer for the next question. Question says, we have to consider the following statements related to what? Let's check it out. It is the potential for investment losses that result from a change in interest rates. Okay. It can be reduced through diversification of bond maturities. Okay. As interest rate rise, bond prices in secondary market also rise. So it is related to interest rate risk. So what is interest rate risk? Sir, interest rate risk basically means, interest rate risk is risk related to the interest rates. For example, I take an example. For example, being a bank has accepted deposit, and the deposit is accepted for 10 years at a 7% rate of interest. And the same amount was given on loan for 20 years, at, let's say, 12%. So bank was expecting a return of 5%, but after 10 years, depositor will withdraw the funds. And at this time, if bank is borrowing the funds in order to maintain its lending standing, then in that particular case, if for left out 10 years, if the borrowing is done for, let's say, 9%, then this NIM, which we call it as net interest margin, which was earlier 5%, now it will reduce to 3%. And this type of risk, where your estimated returns are or your actual returns are less than your estimated returns, that will be the part of interest rate risk. Now the question is, why the interest rate risk arises? Sir, it arises because of the it is the potential for investment losses that result from change in interest rate. That is true. It can be reduced through diversification of bonds. It can be reduced through diversification of bonds. It's true. So rather than investing or rather than purchasing the bonds which are going to mature on same date, it's better you should purchase the bonds which are going to mature on different dates, so that you can utilize the funds accordingly. Next is, as interest rate rise, bond price in the secondary market also rise. This is an important concept. This is an important concept which you need to understand. Whenever interest rate increases, what happens with the bond price? Any idea, guys? What happens with the bond price? Any idea? Bond price decreases. How can you explain this term? You're saying bond price decreases, but how come you explain this particular term? May I have an answer, please? May I have an answer, please? Give me the answer. You said bond price will decrease. How? Sir, if interest rate increases, automatically public investment in the bonds will decrease. So in that particular case, rather than expecting bond price to increase, the bond prices will start decreasing. So that is the reason this statement is incorrect. Rest two statements are correct. So answer is going to be A, option 1 and 2. Got it? Moving on to the next question. The next question is, which of the following operating practices can be used to reduce and eliminate risk in a business? So if you want to reduce or eliminate risk in your business, what type of practices you can follow? What will be your answer? What type of practices you can follow? May I have an answer, please? Okay. Why not reviewing? Why not reviewing? Please think again. There are countless practices, but you have not witnessed one thing. What they are asking, they're asking you operating practices. You need to read this question properly. They're asking you operating practices. Operating practices means the day-to-day operations you are doing. So in the day-to-day operation, reviewing is a day-to-day operation, analyzing is a day-to-day operation, and improving the safety practices improving the operational efficiencies, improving the financial planning methods. They all are the operating practices. So according to that, diversification is not an operating practice. Diversification is risk mitigation practice, where you are investing in different assets in order to minimize the risk. Operating practice means day-to-day operation. In day-to-day operations, if you are reviewing each and every step you are performing again and again, you will avoid operational risk. If you are analyzing on day-to-day basis the steps you are performing, that will decrease your operational risk. So that are the two methods which will help you to eliminate the risk. It will help you to eliminate the risk. These are the operating practices. Are you getting my point? Are you getting my point? These are the operating practices. So they ask you operating practices. They are not asking you what are the methods used to eliminate risk. If they ask you the method used to eliminate risk, then answer would have been mitigation. Then answer would have been diversification. Otherwise, diversification will not be included in this particular discussion. Moving on to the next question. What does the next question says? Which of the risk management strategy is an essential business practice of developing plans and taking actions to reduce threats to an organization? So, which of the risk management strategy is an essential business practice of developing plans and taking actions to reduce threats to an organization? So if you want to reduce threats to an organization, then what you should do? So you should be involved. You should be involved in a process that is known as risk mitigation. So what is risk mitigation? So risk mitigation is, first of all, you identify the risk, you analyze the risk, you assess the risk, and then you mitigate the risk. And the moment you mitigate the risk, it will decrease the threat, or it will reduce the threats to an organization. So risk mitigation is a technique to reduce threats to an organization. So E option is absolutely correct. Moving on to the next question. Which of the following process tracks and evaluates the level of risk in an organization? So how we track and evaluate the level of risk in an organization? What will be your answer? The process tracks and evaluates the level of risk in an organization. Risk planning? No, sir. Risk planning is not correct. We can ignore that. What about rest of the options? Risk analysis. See, which of the following process tracks and evaluates the level of risk in an organization? So the first step is risk monitoring. So risk monitoring is basically the process which track and evaluates the level of risk in an organization. So first of all, we say, if we talk about the procedure, it starts with risk identification, then we talk about the risk calculations. But once we have mitigated the risk, after that, it's a continuous process, risk monitoring. And while we monitor the risk, then we check the risk which we have already mitigated, and we also check the other possibilities or other possible risks on an organization. So risk monitoring is going to be correct over here. Thank you so much for the correct answer. Moving on to the next question. Which of the following statement is incorrect about risk and its types? Government bonds have the highest credit risk. No, sir. No, sir. Government bonds, they have the highest credit risk. No, they are, I would say, less risky because they are funded by government, and obviously the risk is pretty low. So this statement is incorrect. Country risk refers to the risk that a country won't be able to honor its financial commitments. That is true. Liquidity risk is associated with the investor's ability to transact their investment for cash. That is true. Business risk refers to the possibility of a commercial business that can make inadequate profits due to uncertainties. That is also true. What we have to find out? We have to find out the incorrect statement. So A option is the incorrect statement because government securities, they don't have highest credit risk, rather they have the lowest credit risk among all the other instruments which are traded in the economy. Which of the following risk is undiversified risk? Which of the following is undiversified risk, the risk which cannot be pre-calculated, the risk which cannot be pre-estimated, the risk which cannot be diversified. What is the name of that type of risk? So that type of risk is known as what? Systematic risk or unsystematic risk? May I have an answer, please? So which of the following is known as undiversified risk? Systematic risk is known as undiversified risk, which cannot be diversified. Unsystematic risk, this risk can easily be diversified. This risk can easily be diversified. So the answer to this particular option or question is going to be A option. And remember that the answer to this particular question is going to be A option. It's not B. Remember this. Chalo, moving on to the next. Which of the following factors influences business risk that lower its profit or lead to fail? Which of the following factors influences business risk that lower its profit, first point, that lower its profit or lead it to fail? First one is cost of goods, second one is profit margin, third one is geopolitical situation. What will be your answer to this particular question? May I have the answer, please? Think twice before answering. Think twice, please, before answering the question. It may look easy, but it's a good question, I would say. What will be the answer? Remember that cost of goods, yes sir. If cost of goods changes, that means if cost price changes and you cannot change the selling price simultaneously, it will affect your profit. And if you are decreasing or your profit margin decreases, it will obviously lower down your profit. Geopolitical situation, so this situation is not in your hand. This may result in failure, this may result in profit. So it is not always a situation that geopolitical situations will lead to losses. No, geopolitical situations sometimes leads to profit as well. So in that particular case, the answer should be A and B, not C option. So D option is the correct answer. Next, consider the following statement. It refers to the profitability or possibility of default by one of the counterparties in a contract. Okay. It can exist in credit, investment and trading transactions. Okay. Numerical value of a borrower's credit score reflects the level of counterparty risk to the lender or creditor. So which of the following statement is correct with respect to the counterparty risk? So if I talk about counterparty risk, in case of counterparty risk, it basically means a type of risk in which two parties, let's say there is a bank and a borrower A. Bank has lended amount to the borrower A, and against which bank and A, they have signed an agreement. If A do not fulfill the agreement, do not pay back the amount and so on, then we say it's a counterparty risk which falls under the category of credit risk. So it refers to the probability or possibility of default by one of the counterparties in a contract. This is correct. It can exist in credit, investment and trading transactions wherever a contract is signed. If there is a contract failure, it exists. Numerical value of the borrower. Yes, credit score help us to identify the credibility of the borrower, and credit risk depends upon the credibility. So 1, 2 and 3. So according to me, answer should be D option. All the three statements are correct with respect to the given point. Next point or next question is again really very important. If an individual investor or business cannot meet its short-term debt obligations, it is experiencing which type of risk? If a bank or a financial institution or a company is not in a position to bear its short-term debt obligation. Short-term debt obligation means the debt which is going to mature within 1 year. The debt which is going to mature within 1 year. That means the financial institute is facing cash issues. That means the financial institute is not having the appropriate cash. If the financial institute is not having appropriate cash, that type of risk is known as what? So that is known as liquidity risk. Moving on to the next question. Which of the following can be considered as credit risk management process? Credit risk means the risk related to the lending which you are going to do. Risk related to the lending which you are going to do. Now the question says, which of the following is related to credit risk? Now you're trying to manage your credit risk. How can you manage your credit risk? Measurement of risk through credit rating. If you're measuring the risk through credit rating, it's fine. Next is stock or cash flow approach. Stock or cash flow approach? No, sir, it's not a credit risk management technique. Maturity and position? No. Interest rate sensitivity? No. So A option is correct. When you measure the risk with the help of credit rating, that is the risk related to the credit risk. That is absolutely correct. So A option is the correct answer. Moving on to the next question, I have given the solution for every question which you can download in the PDF itself. Which of the following factors can increase the funding liquidity risk? Which of the following factor can increase funding liquidity risk? First, seasonal fluctuation in revenue generation, business disruption, unplanned capital expenditure, decreased operational cost. What will be your answer? What will be your answer? See, if I say decreased operational cost, if your operational cost is decreased, that means you will be saving. You will be saving means your cash hold or cash holding will increase. And if your cash holding is increasing, this means your liquidity risk will decrease. So fourth is not correct. Next, seasonal fluctuation in revenue generation. So if a company is generating a revenue on monthly basis, let's say of 3 or 4 CR, but due to Deepavali, due to the festival season, they are not able to generate the same revenue this month, which will lead to less cash flow, which will lead to liquidity risk. That is true. Business disruptions, if you are not able to do the business at the same level you were doing earlier, that will result in liquidity risk. Unplanned capital expenditure, yes. You have planned capital expenditure and you have kept funds for it. But if there is an unplanned capital expenditure, then what you will do? You will use your reserves, you will use your profits, you will use your day-to-day fund flow in order to fulfill your requirement. In this case, that will reduce cash holdings and it may result in liquidity risk. So according to this, answer should be 1, 2 and 3 are the correct answers. Moving on to the next question. Acha, what are the reasons which lead to liquidity risk? 3 are already mentioned in the question. The rest are increased operational cost, poor working capital management, poor matching of asset duration to debt duration. This is very important, which means that you have lended for 2 years, but you have borrowed for 1 year. That is a poor matching of asset and liability. Then limited financing facilities, poor cash flow management. All these are I would say the cause, or all these leads to what? They leads to liquidity risk. Next, what are the various ways to manage liquidity risk in a firm? What are the various ways by the which we can manage the liquidity risk? If we do effective cash flow forecast, we can manage the liquidity risk. That is true. Keeping track of the liquidity assets, liquid assets. Liquid assets means the assets which can be converted into cash in a span of less than 1 year. That is also true. Then managing and reducing the leverage. So leverage basically means whenever we talk about the leverage, now here is a confusion. The confusion is when we define the term leverage, it is defined in 2 forms. First one is leverage ratio. As defined under Basel norms, that is related to the capital measures with respect to the bank exposure, and its ratio should be greater than or equals to 3%. Later on in India, it's 3.5% or 4% for domestic systematically important banks. Now, leverage ratio can be debt to equity ratio. Liquid ratio can be debt to asset ratio. Leverage ratio can be debt to capital ratio. It can be debt to capital ratio. So managing and reducing the leverage ratio. Managing and reducing the leverage ratio. Debt to equity, if you are reducing it, it's good. Debt to capital, if you are reducing it, it's also good. If you're reducing it, it's also good. Debt to asset, if you're reducing it, it's also good. So if you're reducing the leverage ratio, it will help you to manage the cash pretty well. So answer is going to be A, B, C, all three of them. So remember, leverage ratio can be defined as, or in leverage ratio, we include debt to equity ratio, debt to asset ratio, and debt to capital ratio. Clear, guys? Are you getting my point? Are you getting my point? Okay. Moving on to the next question. The next question says, we have to consider the following statements related to operational risk. Let's read out the statement. First one, it is heavily dependent on market related factors. Operational risk is dependent, operational risk is dependent on, operational risk is heavily dependent on market related factors. Is it true? Market related factors, is it true? No, sir. Operational risk is related to day-to-day operations which are performed by the company itself. How it is dependent on the market? Sir, it is heavily dependent on human factor like mistakes or failures due to the actions or decisions which are made by the company employees. So every firm or individual must deal with such an operational risk in a completing any task or delivery. I read it again. Every firm or individual must deal with such an operational risk in, obviously you have to deal with it while completing every task. It can create damage to brand name. Yes, sir, it can create damage to brand name. So according to me, answer should be 2 and 3. First cannot be the answer because it depends heavily on human. It depends heavily on human factor, not on the market factor. Next question. Now we have systematic risk. We all know what is systematic risk. We all know what is systematic risk. Let's read out the points for systematic risk. It refers to the risk inherent in the whole market or a part of the market. Okay. Whole market aa gaya to theek hai. It is also known as undiversifiable risk. Yes, you cannot diversify it. It cannot be diversified away by holding many securities. That is also true. So according to me, all the statements are correct. 1, 2 and 3 related to the systematic risk. I hope it is clear to you. Is it clear, everyone? May I have yes sir in the comment section, please? Moving on to the next one. The next question says, which of the following statement is correct with respect to the unexpected loss? Unexpected loss. So generally loss is unexpected only. Still, let's read it out. It is the volatility of credit losses around its expected loss. Okay. It requires capital allocation. Okay. It is the amount of economic capital required by the banks to support various risks. So what will be your answer? Unexpected risk is basically the risk beyond expectation, or the risk which we have not pre-calculated. So it is the volatility of credit losses around its expected loss. That is true. So you have a expected loss, but if the borrowings which have been, or the lending which have been done, if that lending cannot be recovered and the losses increase, this could be a reason. That is true. It requires capital allocation. Yes, sir, you need to allocate the capital in order to counter it. It is the amount of economic capital. Yes, that is true. So according to me, the answer is going to be E option. A, B, C, all are correct for the given one. Moving on to the next question. Okay, Assets can immediately be converted into cash without any loss in value and are ideally considered eligible by RBI is termed as. So those assets which can be easily converted into cash without any loss in their value, what these assets termed by RBI. So RBI call these assets as what? Sir, RBI call these assets as high quality liquid asset, for example, government securities. So high quality liquid assets, if you remember, SLR, statutory liquidity ratio, are the ratios which are, or are the assets which are maintained by the bank as a reserve, and RBI allows only high quality liquidity assets to be included under the category of SLR. So those assets which can be converted into cash whenever required, and that too without any loss. And that too without any loss is basically considered as high quality liquid assets by RBI. So answer is going to be A option. Moving ahead. Which of the following statement is correct with respect to the net stable funding ratio? Net stable funding ratio. If you remember, net stable funding ratio was the term which was introduced, it was introduced in Basel norms, especially in Basel 3. Net stable funding ratio says every bank should maintain net stable funding ratio of value greater than or equals to 100%. Greater than or equals to 100%. What is it, sir? It is available stable funding upon required stable funding. What is required stable funding? So the funding required to pay short-term debt, or funding required to pay debt which is going to mature in 1 year. So all the payments which you are going to make, all the liabilities which you are going to pay back, or all the liabilities which are going to mature in a span of 1 year, they are known as required stable funds. And available stable funds means the funds which are available with you in order to pay these liabilities. That ratio should be greater than or equals to 100%. That means your available stable fund should be 100% of RSF or greater than 100%. So it is the ratio of amount of available stable funding that is true. It promotes resilience over short term. Yes, sir. Resilience means self-dependent. Yes, sir. We will be self-dependent. We will be strong. We will be in a strong situation in this particular case. We will be in a strong situation in this particular case, but it promotes resilience over short term. If we say short term and long term debt, and if we are talking about the debt which is going to mature in a span of 1 year, it is itself a stress test on liquidity run over 1 year horizon. Yes, sir, it is 1 year horizon. That 1 year part is correct. But the question is, debt which is going to mature in a span of 1 year will be short term or long term? What will be your answer? What will be your answer, guys? Is it a short term debt or long term debt? Will it be termed as short term or long term? Chalo. There is a confusion in this particular question. If you ask me, I have a clear answer on this. I want to discuss this term short term and long term. It's a very confusing term. Sometimes we say short term for 3 months and long term for more than 3 months. Sometimes we say short term for less than 1 year and long term for more than 1 year. So let's mark this question, and I want you all to check. I want you all to check that whether it is short term or long term with respect to the NSFR. Next, which of the following statement is incorrect with respect to the credit risk? Credit risk is subject to banks only. No, sir. It is subject to all the financial institutes which are involved in credit, which are involved in lending. Fund managers and investors are directly exposed. Fund managers and investors are directly exposed to credit risk in their fixed income investment. What is fixed income investment? The type of investment the type of investment where you are going to earn fixed income. For example, if you have invested in the debt instrument, against the debt instrument, you will be receiving fixed interest rate. Now, if you're receiving fixed interest rate in that particular case, are you exposed to credit risk? Yes, sir. This is true. Credit risk traditionally refers to the risk that a borrower or a counterparty will fail to meet its obligation. That is also true. So what we have to find out? We have to find out the incorrect statement. So A option is correct because A statement is incorrect. Next, which type of risk occurs due to an institution's capital or earning through breaches or non-compliance with law, rules and regulations? So if a company do not fulfill the rules and regulations, then what type of risk company is going to face? So that type of risk means when you do not fulfill the compliance, RBI compliance in case of bank, that type of risk is known as compliance risk. It can also be termed as legal risk whenever or in that manner it can be used. Next, this type of risk is the risk to capital or earning arising from changes in the market value of asset. Okay. It generally arises from transactions in interest rate. So what will be the answer? Anyone? E option, liquidity risk. It's a good question. Please pay attention. This type of risk is the risk to capital or earning. This is a risk related to your capital or related to your earnings from changes in the market value of asset. When market price of asset changes. So if the market price of asset changes, it will lead to change in your profits. It will lead to change in your earnings. Please pay attention. Link it with bonds. Bond price changes. If the bond price changes, it will impact your capital or earnings. Similarly, bond price is impacted due to change in interest rate. It is impacted due to change in interest rate. So whenever there is interest rate involved, normally arises from the transaction in interest rate, bond prices changes. So that type of risk is price risk. So whenever your asset price changes or your market value of the asset changes, it leads to change in your capital or profit or earnings, and that too the price changes because of interest rates, that will fall under the category of bond price, and bond price risk is known as price risk. Is it clear, Parmeshwar? Will you remember this now? I hope you will remember this from now onwards. Moving on to the next question. Okay, so these were the questions for today. I hope all the questions were clear to you. You must have enjoyed the discussion. We'll catch you at 8 p.m. today on the same channel where I will be discussing with you a very important topic, that is negotiable instrument. Thank you so much. I will be sharing the PDF of this session on my Telegram channel. Bye bye. Good luck.